Ladies and gents, good evening. I'm Simon Brown doing this evening's presentation. So this evening we're looking at ETPs, exchange traded funds. We're going to look at being tax efficient. This, of course, is predating our finance minister, who will be talking tomorrow, 2 o'clock our time, where he will deliver the budget for 2025/6. This evening's presentation, and I'm referring to ETPs, and a lot of folks have said to me, hang on, what's an ETP? ETPs are exchange traded products. And it's a broad category. What it means is that they are exchange traded. They trade on the exchange. In our example, they're trading on the JSE. So they're things that you would buy in a normal JSE account as you would buy any other share or other product on the JSE. There will be a basket of shares following an index. That will be passive. I'll come to that in a moment. A methodology, a lot of methodology coming through. For example, you can buy one on US private credit. You can get a one that tracks the fuel price or the diesel price in South Africa. SA small caps, offshore small caps, commodities. That list just gets bigger and bigger. And it's really, really great for us as individuals because it means we can really get tactical with our portfolios. Now, should we or not, we'll talk about that. There are T's and C's around it, but it does open up a sort of space for us as investors, which we simply didn't have 2 years ago. We had a lot, but those AMCs are huge. And then sometimes it's just a fund manager. So a fund manager, a Coronation or someone like that will say, well, we've got a unit trust. Let's also put it on the JSE. And that's the key thing. ETPs are kind of unit trusts in many cases. The key difference is with the unit trust, you buy it from the provider, either via a list or directly from the provider, whereas here you buy it on the exchange. In your normal OST or ASI account, you would buy it as you would anything else. They are cheap in terms of fees, and the fees part is important. I'm not saying that, some of them might trade at $100. That's not the point. The point is they're cheap in terms of fees, typically sub 1%, in some cases in the AMCs as high as 1.5%, but they are cheap, and that's important. If there's, we all want free, but we're not going to get free. There's fees to be paid. If there are fees to be paid, my favorite fee is always going to be lower. The diversification is huge, and that's really what we've seen over the last 2 years, especially last year, is a significant increase in the range, and then hence the diversification as we as investors. I mean, the numbers that the JSE has shrunk from, 600 plus shares to barely 300 shares that are investable. Sure, that's a trend we've seen worldwide. The reasons aren't important. It's not unique to the JSE, but the number of listed instruments on exchanges the world over are shrinking. But we're being replaced instead with these ETPs, which do give us range. Some of them, for example, FNB's got a range of ETNs, which are single stock ETNs. So you can buy MasterCard, NVIDIA, and a whole bunch of others on the JSE in rands, but you technically have got an NVIDIA share. So it increases the range for us. Yes, we don't have many new Anglos and Standard Banks and Capitechs and the like, but that range of what we can put in our portfolio. I own NVIDIA two ways. I own it in the US via my Shift account. I own the ETN in South Africa on the JSE and my standard online share trading account. That was my election hedge because it's got the RAND component. And I thought, look, if the election goes completely pear-shaped, then the RAND will collapse and I'll make money anyway. And it's just been doing so well, I still have it. So NVIDIA is a crazy beast. Some are allowed within tax-free investment accounts. We'll touch on more of that in a detail. I want to come back to that passive part in a moment. When I'm talking around a typical unit trust or your portfolio, we're talking active. In other words, you look at the universe out there that you can invest in, and you make an active decision that you want to own this share or that ETF or this AMC. That's an active decision. And many of the AMCs and the actively managed ETFs are active. There are fund managers sitting in the background who are deciding what to hold, what percentages, what weightings, what to buy, what to sell. A passive is where there is an index, for example, the top 40 index, that is the 40 largest shares on the JSE, and that fund just buys those 40 shares, nothing else, those 40. Once a quarter, the JSE will decide which are the biggest 40. They might kick one or two out. They might bring one or two back in. And as they do that, the fund manager will then balance accordingly. But they are completely passive. So you can buy an S&P 500 ETF in South Africa in rands, and you will have the 500 shares that exist in the S&P 500. They take your ZAR, they turn it into dollars, and they go buy those 500 shares for you. So it's a great way to get very quick, very broad diversification. And I mentioned the top 40 with 40 stocks, the S&P 500 stocks. There's an ETF here, 16,000 shares, which is, so you still got some concentration, but your concentration is quite small, and that's not unimportant at all. So exchange traded products. ETFs are the ones that we know best. They are the ones that started 24 years and some change ago. Satrix, we'll touch on that in a moment. They are passive in that they track an index, and that index can be almost anything. I mean, some of them will be country-based, some of them will be the top 40, but even in South Africa, you can go and get the Indy 25, which is industrials, the FINI, the resources. So you can narrow it down if you're looking for a particular space, a particular segment of the market that you think is going to be doing extra better over the next period of time. There are some commodities included in there as well. We've got a platinum, a palladium, and a gold, which is single commodity. So, for example, you buy GLD on the JSE, and each GLD is 1% of a Kruger Rand. So if you buy 100 of them, you've effectively got a Kruger Rand. But you don't have to physically hide the Kruger Rand, bury it in your garden or wherever you hide your gold coins. What you also don't have is something when you need a coin toss. That to me is the reason to have a Kruger Rand, right? You've got to toss a coin, pull out the Kruger Rand, because that's going to intimidate everybody. So ETFs have been around since the mid-90s globally, South Africa 2000, and they very much do what they say on the sticker, except something's going flat here. Let me go there. We also get exchange traded notes. Exchange traded notes are slightly different in the sense. They are, as I said earlier, the FNB rather, who issues single stocks within an exchange traded note. You'll also find a lot of commodities within the exchange traded note. Rhodium, there's an oil, there's a copper, there are others out there as well at the same time. These are slightly different to the ETF. In the ETF space, you are physically, they go and buy those shares. So the top 40 ETF, they have those shares. If the provider, the issuer, were somehow to go bankrupt, not a problem. The shares are there. They're ring-fenced in a special purpose vehicle. They can liquidate it. They can hand you the money. The exchange traded note is different in that you are technically taking credit risk. They might not hold it. They might have they are promising you the return. They will use derivatives. They might physically own the share. So if you take, for example, my NVIDIA ETNs from FNB, if FNB goes bust tomorrow, I join the queue outside their head office to get my money back. Truthfully, we got bigger problems, right? If FNB is going bust, I'm joining the queue to Zimbabwe. So I'm not particularly stressed by that. It's all the big banks, and all the big banks are there. They work. They're happy. So those are ETNs. There's a bunch of them around as well. They are nice. They certainly do what they say on the sticker. You can't put them in tax-free accounts. This really is not happy. Oh, it does work. It's just slow. Then we have actively managed exchange traded funds. They're relatively new in the world. And what it is it's kind of like a unit trust. And in fact, we've seen Coronation launch some actively managed exchange traded funds. So all they're doing is they're taking one of their funds, I don't know, the top 20 fund, which is a unit trust, and they're saying, well, you can also buy this on the JSE. Why would they do that? Distribution. I don't own anything that's outside of the JSE for simple reasons. I'm too lazy to do more FICA. I don't want other accounts. Everything for me sits nice and simple on the JSE in my OST account, done and dusted. Now suddenly I can buy the Coronation. Do I want to? Well, that's up to you, but it is there, it's available, it's possible. That's what's massively important. And I think we're going to see a fair bunch of actively managed ETFs coming through. They're also technically cheaper for the issuer than a unit trust. So I think we're going to see more and more coming through. And as I said, the likes of the big ones, the Coronations, the Allen Greys, the Stanlibs, etc., they're going to look at this as just extra distribution platform for them at, frankly, not very much extra cost at all. So I think we'll see it more coming through. And then the actively managed certificates. We did a presentation with Kevin Swartz last year around actively managed certificates. They are fairly similar to actively managed exchange traded funds. Key difference is you could, if you wanted, put derivatives in them. You can have more performance fee based in them, and you've got much more scope for what you can practically put inside of them. And I think we're going to see a lot more of those coming through. That's where, for example, you can get US private credit. You can go long or short of diesel. You can get small caps. You can get commodities. There is going to be, I think, an explosion of the broad-based, but also the very sort of niche stuff coming through. You know, why haven't a China tech? Why not a China tech? Is Xi Jinping and Jack Ma are friends again as of Monday? So why not a China tech AMC? The actively managed ETFs and the AMCs are the two that are relatively new in our market in South Africa, coming out towards the end of, I got to work my years out, 22 and 23. So here's an example of the top 40. That's the 40 largest shares on the JSE. It is actually more than 40 shares. There's some complexities, but we won't worry about that. It's the 40 largest shares. And what you will see is those are the top holdings. That is the top 10 positions as of the end of December. We don't have more up to date because that's the last quarter end for the minimum disclosure documents. It's a lot of NASPAS, then some banks, process, some gold, more banks, British American Tobacco, and ultimately there are 40 stocks. You've got some concentration. NASPAS and process essentially the same at about 17.5%. You've got a lot of bank exposure. But let's take a scenario where, I don't know, PGMs go to 3,000, gold goes to 5,000, and then suddenly you'll find miners at the top there. And that's what I like about it. It's kind of self-cleaning in a sense. You know, if China, if Tencent, which is really what NASPAS and process is, if Tencent shut down tomorrow, it's going to be nasty. It's going to hurt a bit. But immediately other stocks will come and take its space. And that's what's so nice about the passive nature of a ETF, a top 40, a S&P 500, whatever the case may be. It just does what it says in the sticker, 40 largest companies. And as things change, it adjusts accordingly. And the changes here have been significant. The first one was the Satrix, listed in November 2000. Listing price was R7.74. Yesterday it was trading just under 81 Rand. You've also had almost 25 Rand in dividends over the period. So you've got about a 14 bagger over the 25 years since it first came to market. And back in the day, this was all about BHP, Anglo, the miners. Because in the early 2000s, we were a mining economy more than anything. We had that commodity boom running up until 2006. Back then, NASPAS was like, I don't know, Mnet. I mean, I suppose Mnet is still out there somewhere, and then the DSTV banner. But I mean, it's that sort of thing. Now, suddenly, you know, they own one of the biggest China tech stocks in the world, and they're dominant. What's also interesting is there are 4 different issuers of it. You've got One Invest, which is the Standard Bank offering. You've got Satrix, FNB, and Signia. And they're all going to be the same inside. They're all going to have the same shares. What is going to be different is the fee that they charge, i.e. the issuer, whether it be FNB, Signia, Satrix, or One Invest. And we call that a total expense ratio. Now, the expensive one here is 0.3%. The cheap one is 0.1%. The fun fact is that we're arguing over 0.2%. Again, if you have a choice, you want that 0.2 in your pocket. But for reference, when I bought my first unit trust in 1996, my fee was, I think, 5.5%. Yeah, there was a performance fee as well, but it never performed, so I never got charged the performance fee. But I mean, it's the place we find ourselves, where suddenly you're like, huh, look at that 0.2 difference. You know, when I was buying that unit trust 30 years ago, we didn't know what fees were. We're in a golden age for private investors. So you have choice. There are other fees in a sense, and what I mean by other fees is there is the spread. In other words, on the market, when you buy it, the issuers have a market maker. There's a fair value for this ETF, right? That's what the index plus any accrued dividends are. So let's say the fair value is 80 Rand and 50 cents. They will be selling at 80 Rand 60 and buying at 80 Rand 40. In other words, you buy at a slight premium from them and you sell at a slight discount back to them. That's technically a fee too. That's a one-off fee. You only do it when you purchase and you do it again when you exit. It is a fee. And there are, if you really want to get into the weeds of it, go and monitor and see what the different spreads are, difference between the buy and the sell price. Because you'll notice, well, some of them that difference is 0.1, others it's 0.25. That negates the point. Yeah, depends how technical you want to get into the process. You can get very, I'm more agnostic in terms of the spread, simply because, as I said, I pay it once when I get in. I mean, I literally bought that Satrix 40 in IPO in November 2000. So I paid that spread once. That was it. Yeah, 25 years later, or 24 years and change, I still hold it, but I haven't paid it. I haven't had to pay that spread again. And they've all come down. I mean, the Satrix 40 used to charge 0.8, then it was 0.4. That was quite exciting. Now it's 0.1. Globally, there's some ETFs at 0.03%. I don't think we're going to get below 0.1. We're just not. I mean, that is the VOO, which is the largest ETF in the world, I think, or one of the largest. That the assets under management of that ETF is more than the JSE. So I don't think we can get much below 0.1%. Just some quick data. So this is from ETFSA. Mark Brown puts together a quarterly update. This is for the year ending 2024, and it's 31 December. You can see the growth coming through. Big jump up last year up to 225 million. Comparatively, I mean, let's again go to Coronation. They've got about 225 billion. Coronation's got about 600 billion in assets under management. This is still a relatively small industry. Some of that growth, of course, was because the beauty of last year, markets went up. Love me a market going up. So that obviously also just lifts the value of all the various different products within there. But what we have seen is there has been fairly significant growth in the actual number of that's the one I want. In terms of actual growth, so end of 23, we had 211. End of last year, we had 254. You'll notice there was actually a decrease in ETFs. Satrix took over a lot of the ABSA products, did some mergers, some closing downs. So we lost a few there. We saw a few exchange traded notes. Those were mostly F&B and the single stocks. You will see a big jump in actively managed certificates and a big jump in actively managed exchange traded funds. And I think those are the two areas that we're going to see a lot more growth in the year or three ahead, as we see different fund managers, different financial institutions come with. I think we're going to see a fair bit of innovation happening in that space. Some of it's going to be a little bit sort of maybe less exciting. You know, it's going to be Simon super stocks and like, really, who's Simon? But I think some of it's going to be lacquer. We're going to see some great stuff coming through there. The one thing, and I say this as someone who has gone down that road, like a kid at Christmas, you want to eat every piece of candy or the cake and the pudding and everything else, and you feel ill for days afterwards. I used to have a portfolio where I had a little bit of everything, because everything that was issued was new, was just shiny and exciting, so I bought some. And then there was another new thing. Oh, so I then bought some of that one too. And I remember one day scrolling through my portfolio, and it took like 3 or 4 scrolls from top to bottom. And I thought to myself, young man, well, middle-aged man, you have too much. So I cleaned out all the small ones and concentrated it down. So careful of the thrill of, hey, there's, you know, new and exciting. We need to have a little bit of everything. In terms of the issuers, Satrix is the biggest, largely because it used to be Satrix Insignia neck and neck. Satrix, as I said, took over much of the ABSA products. UBS is issuing in the ETN and AMC space. 10X took over the core shares portfolio, so they've got a couple there as well. FNB One Invest. Standard Bank has got AMCs. The AMCs from Standard Bank and UBS are third party. So it could be a Standard Bank portfolio, but Standard Bank or UBS is providing the, for want of a phrase, the infrastructure for the AMC. So someone comes along and says, cool, I want to do this AMC. They meet all the requirements from Standard Bank, and then Standard Bank essentially puts it on the books, and it's credited as a Standard Bank actively managed certificate. But it's unlikely to be Standard Bank running it. It is third parties, investment managers who are actively running it. Prescient, Easy ETFs, they took over the bunch. They've got 3 quite small, 24/7, and then Core Solutions, which is the ETFSA. We'll come to that in a moment. So 12 issuers in total, good value coming through. You can see ETFs is 185 of the 225, so by a long way the big one, but it had a 20+ year head start. It's just going to drive me dilly. So, and that's not looking so great. So just a quick look at some returns. I want the positive returns first, and it's not showing on the screen, so lacquer. But essentially, I mean, we've got 1 year returns. We've got the Satrix Resi at 20%. We've got the Sharia at 14%. The 1 year return on that is 18. They make money. Now, let's be clear. They're not going to ever do you an NVIDIA. They're not going to 10 bag in 2 or 3 years. That's not what you're doing here. And we'll talk around portfolio construction in a moment. That's not their process. What they do and do very successfully is they are broad market. And when you are in bull markets, which is what we had yesterday and last year, and touch wood, what we're having so far into 2025, we have a bull market. Things are going up. There's all-time highs left, right, and center. Your ETP portfolio will be following along and will be rising at the same time. On the downside, I mean, over the short period, we've got Satrix India down 9% year to date. We've got Satrix Property down 3% year to date. That's after doing 35% last year. So there has been some red this year, but mostly it has been all guns blazing and heading to the moon. But how do we fit all of this together into a portfolio? And the short answer is, the question I get asked often is, can't I just buy ETFs? Can't I just have an ETF portfolio, 100% ETFs? And the answer is yes. The answer is that for most people, the vast majority of people, a pure ETF portfolio is probably the right thing to do. I'm thinking my sister. She doesn't got the inclination all the time, or truthfully, the skill set to go and pick stocks and clever this and clever that. She just wants to invest some money every month. And when the market goes up, she's a little bit richer. And over time, she'll create wealth. So for her, it's 100% ETFs. We're probably in the view that we want to be a little bit more active. And then we position the portfolio. Down at the bottom, we have our base ETFs. I'll talk about those in a moment. Then in the middle, we can have some thematic ETFs, or we could have some actively managed certificates. And at the top, if we want, we can go and have some individual stocks. And that's broadly how my portfolio is positioned. It's about almost 60% is my base ETFs. My thematic for me is more individual stocks. My stocks at the top of the pyramid is what I call my second tier stocks. So small caps, mid caps, I'll hold them for as long as they're going up. When they're not going up, I'll take the money and run. And then right at the top, I have a little bit of trading capital. But that base is broad-based ETFs. Because the biggest risk to my portfolio is not a politician or a finance minister or anything like that. Biggest risk to my portfolio is me. I'm the oak who can do the stupidest thing in the morning before 5 o'clock in the morning. Now, I can sell the wrong thing at the wrong time. I can buy the wrong thing at the wrong time. I can over-diversify. I can under-diversify. I'm, frankly, the biggest risk to my portfolio. So I manage that risk by putting a lot of ETFs in there. Then I have some blue chips above it, what I call my second tiers. But for most folks, it would be the boring ETFs, the thematic ETFs, and then if you want, some stocks at the top. Your thematic would be, for example, you think tech is exciting. So you go get some tech ETFs, maybe commodities. Maybe you think it's all about China. We've got 2 locally listed China ETFs, you know, that sort of thing. Maybe you think that commodities are going to do really well. So you go and get the commodity AMC, actively managed certificate. And you take those sort of thematic bets. The problem with those is that it's hard. I mean, it's easy now to say tech is hot. A decade ago, probably wasn't so easy. 5 years ago, maybe. But then what happened in 2022 when we had the tech meltdown and the bear market and the Nasdaq lost 40% in 14 months? And your job is not to panic. I'm losing a pile of money, but don't be scared. That is counterintuitive. Losing a pile of money is scary. That's just, you know, fear 101. So the problem with thematic is that you've got to get the theme right. Then you've got to get the entry period right. Then you've got to get the exit right. And then you've got to rinse and repeat. That is hard. That is very hard. So I have some thematic. I don't have a lot. I've got Resi, which has done poorly. But what I'm taking on Resi, at some point, will there be a commodity bull market? Yes. In my lifetime? Sure. Soon? I have no idea. I have no idea. So I was buying some Satrix Resi towards middle of last year, thinking, you know what, it can't get much worse. Well, it did. It's looking good this year. It didn't look so good last year. It's a small position, and it's the view of, I know that commodities are going to run. I don't know when. I can take a little bit of pain. I'm certainly not buying at the top. So let me have some commodities in that space. So I'm early to the commodities. Tech, I was late. I've got the ETF 5IT, touch on it in a moment. Tech, I was late to the party. I had some individual stocks, but I was late to the broader party. But then at some point, you know, and you've probably all experienced this, you look at it and you think, yeah, I missed that bus, blast. And then you come back in 6 months and you realized, oh, there was another bus. I missed that one too, blast. You know how this story goes, eh? And they're just buses, one after the other, one after the other. And you know what? One day that tech bubble pops, guaranteed, promise you. No idea which day. So for now, I am holding tech. Individual countries, I don't hold. I mean, obviously, I have a lot of SA because I live in South Africa, I work in South Africa, I've got Reg 28 in South Africa. But as a rule, I don't have individual countries. I just find them difficult. I can look at India and I can see the story, and the story is compelling on a dozen different ways, and the market's going down. Why is it going down? I don't know. I don't know. I go look at the companies that are in the Nifty 50, which is the Indian index, and I don't know what they are or who they do, or I just don't know. So what you want in something like that is probably an actively managed certificate. I think what will be great, we've got some emerging market stuff. I'll touch on that in a moment. I'm interested in frontier markets. You know, forget India and China. What about Vietnam, Bangladesh, Chile? But then I really need an expert. So, I mean, I was chatting with one of the guys, I think from Alan Gray. Their biggest challenge is like Egypt. The documents are all released in Arabic or some language that is not English. They're often released weeks later after results, and they're never translated into English. So first thing, learn Arabic. I'd struggle with English, so we'll park that there. So those are the products broadly. We're going to come back to them a couple of times. Let's talk around different tax options, and in this particular case, tax-free investing. We've got Reg 28 retirement investing. We've got interest exemption. I'm going to go into all of those in a lot more detail in a moment, but there are two down at the bottom I want to touch on how we can be efficient with our tax. One is donation to a charity. Importantly, a charity needs to be a registered public benefit organization, PBO, must be registered with SARS, and they must show you the certificate, and it must match. And then at the end of the tax year, which is Friday next week, 28 Feb, they will issue you a certificate. And if you gave that charity money, you can then deduct that from your income. So you don't, I mean, the tax saving is that you pay less tax, but you have to give the money to somebody, which is fair. You're giving money to a charity, and maybe you've got a heart of stone, which is fair too, and you don't want to give money to charity, but that is certainly one way that you can do it. You give money to recognized registered charities, and you can claim that back. They must give you, they must prove it to you with a certificate from SARS, and then they will give you a Section 18 perhaps. Anyway, they give you a certificate which says Simon donated X, and thank you very much for your money. Donations to non-charity, I can give 100,000 Rand to anybody I like. I don't get any benefit, but it's tax-free in the hands of the person I give it to. Now, if I gave 200,000 Rand to a person I like, the first 100,000 is tax-free. The next money is taxed at 20%, and I pay the tax. Why would you do that? Well, you might have an elderly parent who is in a low tax bracket, or you're helping them financially. You might want to do it for kids. You might just be a very generous person and like handing out 100,000 Rands to people in the street, in which case I'll be outside in 40 minutes and I'll take you 100K. Importantly, you can also donate money between spouses. There is no limit. So if you're married and your spouse hasn't maxed out their Reg 28 or they're tax-free and you've got some cash, you can donate to them, no problem. They can then top up their tax benefits. No limit on spouses. Need to be a spouse. So that's important. So those are two. I'm not going to go into more details into those because they're small and not so complex. But let's start with tax-free investment accounts introduced in 2015. Pop quiz: who was finance minister in 2015? Nklanhla. No, Nklanhla. Who was finance minister the year after? Melissa Gagaba. Hey. Oh, Des didn't last. No, Des was that. He was that December, but he only lasted the weekend. Then we got yeah, but before Praveen we got Melissa Gagaba. Then we got yeah, we went through a lot of finance ministers. It was real there for a minute. Introduced in 2015, paid from post-tax money. This is important. You've received your income, you've paid your tax, you've got cash left over, you can put it into a tax-free investment account. Sometimes called a tax-free savings account. I don't like the savings account because it should be investing, not saving. I think that distinction is important. It has to be a tax-free account. You can't just say to SARS, oh yeah, that's my tax-free account. You must practically go to your provider and say, I wish a tax-free account. You can do it in online share trading. You can do it in internet banking within the ASI part. You can go and get yourself a tax-free account. It is anointed, it is flagged as such, and SARS will recognize it as such at the same time. And then into that, you can deposit funds. There are limits, 36,000 per year, 500,000 over your lifetime. That 36,000 might go up tomorrow. That's why there's an asterisk. I don't think it will. The 500,000 is moot because we've only been able to put 339,000 in, so we're not yet there. I also think Treasury is going to take the view. A lot of people are saying 500K is not enough, and I think Treasury is going to say, oh, 1%. I don't think Treasury is going to push that 500 up very much. They also can lose potentially a lot from it, and I'll explain why in a moment. Do not exceed the limits. Do not think, oh, I'll put 100,000. Then if you exceed the limit, Treasury will fine you at 41% of any excess deposit. 41%. I'm sure you love your country, but I'm not sure you want to give them 41% of your money.
But can you then leave the rest in there?
That we don't know. No one has tried it. The math is good, but you go first. I've had more than a lot of people ask me that question, and I've always said to them, you first, young man, young lady. They've never come back to me. Yeah. So we don't know about that at all. At this point in time, we'll just stick to those limits. Everything in there is now tax-free. So you make a profit. There's no tax on the profit. There's no CGT, capital gains tax. You receive income from a REIT. You receive dividends. Income is added to your income. Dividends are taxed at 20%. There is no tax paid on those. So it is a material saving over time. And that's why I say I think Treasury is being a little bit careful about it. And I'll show you some numbers why, because the numbers get very big given time. Very important. Tax year, 1 March to 28 Feb. So Monday next week, which is 3rd of March, new tax year, new 36,000. Do you have to do lump sum? No. You can do it monthly. You can do lump sum. You can do less if you don't have the full 36,000. You can do 3,000 a month. You can do 5,000 this month, 10,000 next month, whatever you want. That's not a problem. You can do 500 Rand a month if that's all that you can afford. If you don't do the 36,000 this year, what you didn't do does not roll to the next year. So it's 36,000, 1 March, resets. There are limits as to what you can buy. That is hugely important. You can't buy individual shares, etc. You've got to buy ETFs. There are a few things. We'll come to that in a moment. This is a really, really great product. We're only a decade in, so it's still relatively new. There's somebody out there who's got a portfolio, notwithstanding she only put 339,000 into it. Her portfolio is nudging 950,000 Rand because this lady is a trader of note. Yeah, she won't send hot tips, but man, it's like, I've actually seen her portfolio. Everything she buys is in the money, like in 5 days' time. And then in a month or so, she's like, oh, lekker, sell that, buy that. It is like, she is like, I don't know, she is astounding. But for most of us, we're probably not quite at that level, but and it's growing. And you know, the 500, I'll come to it. The 500 doesn't seem like a lot, but as I said, it does get there in time. So what can we buy? We can buy ETFs, we can buy actively managed ETFs, we can buy unit trusts, we can keep cash in there. Unit trusts, of course, you have to be in a list platform, and I don't think that cash is a good product for this unless you are in retirement and have lots of cash that you wish to be earning interest on and not paying tax. We'll come to more of that in a moment. There is one thing I think Treasury should do, is I think that if they should say that if you're over 65, the annual limit falls away and you can put the full 500,000 in. Not because you haven't got time, but because you might want to use the cash component of it. But Treasury has other issues. What can't you put in? You can't put in individual stocks, not local, not offshore. You can't put in ETNs. You can't put in actively managed certificates. I expect that to change. No derivatives, nothing with performance fees, nothing with commodities. What Treasury is trying to make you do, and I know this because I was in some of those early meetings, is they don't want you to get wiped out on one disaster. In other words, they don't want you to have everything in Steinhoff and, oh dear, where did my retirement go? They are forcing you to diversify. And I'm not uncomfortable with that. You know, this is your first 36,000. The rest you can go and buy stocks and derivatives and pay performance fees and all of that. But they are saying you need to diversify. They don't want risk. And that includes commodities as well. You can't buy offshore anything. So you find an ETF listed in New York, it needs to be JSE traded. That JSE ETF could reference offshore equity. It could be an S&P 500. It could be a tech ETF, absolutely. But you buy it in ZAR on the JSE in your tax-free account. You can transfer between providers. If you don't like your current provider, you can request a transfer and move to another provider. Very important. Do not draw the money out. Here's the thing with money. So you've got a 500,000 limit. You've put 100,000 in, so now your limit has dropped to 400,000. You take 50,000 out. Your limit is still 400,000. The limit doesn't reset as you take money out. So if you do a transfer, you practically do a transfer. You contact the new provider, they will give you documentation. You contact the provider you're leaving, they will give you documentation. You fill it in, you send it off to the various different providers, and that process will happen. You practically need to do a transfer. Why would you transfer? Because there are platform fees you don't like, the product range isn't attractive, there's a bunch of reasons for transferring. You can transfer. You can also have multiple accounts. But here's the thing, the limit is 36,000 per year per individual, not per account. So if you have 10 accounts, your limit is not 360,000, it is 36,000 across 10 accounts. So you can have multiple. I'm not sure why, I'm sure someone's got a reason, but that limit is per individual. You can withdraw the money whenever you want. There is no restriction on withdrawals. But remember, that doesn't reset your lifetime limit. In an ideal world, this is the last money that you spend. Because the longer it stays in there, the more you get that tax-free benefit. So this is the last money. You want to spend your Reg 28. You want to spend your kids' inheritance. You want to spend everything. And then you come to your tax-free account. You can transact within the account as often as you want. So you can buy and sell like crazy. That does not impact your limit. If you put 36,000 Rand in and you get a dividend of 3,000 Rand, that does not impact your limit. The only thing that impacts your limit is money going into the account from outside. Once the money's in there and you buy something and you get dividends, well, that's great. But it's not an impact on the limits, either annual or lifetime. If you sell one and buy another, you decide you don't like that ETF, you want to buy that ETF, you can transact as often as you want. You could turn that entire portfolio 4 times a day. SARS doesn't mind. As long as it stays in the account. That's what matters. And that is the question I get most often. Oh, I put 36,000, but then dividends made it 40. That's fine. It's what you put into the account that matters. And yes, you can transact until you are absolutely blue in the face. So here are the numbers. This is why I don't think we're going to see much change to the 500,000. And I appreciate many of us are perhaps a little older, so we don't have the full benefit. A child is born today and you put 36,000 Rand into their tax-free account and you do nothing. We get a 7% real return, in other words, 7% return after inflation. And at the age of 65, that's worth 2.9 million. I have removed inflation, so that is in today's money. That's not fake money in 65 years' time. Your 36,000 has grown to 2.9 million Rand. Using the 4% rule, which says you take 4% a year to live on, and it will continue to grow, and you will die with a pile of money, you're getting 117,000 per year tax-free. Now, let's be clear. 117,000 is nice, but maybe a modest retirement. I mean, if you're drinking wine, it's definitely in a box. Eh? This is not fancy French stuff for, and let's be clear, a box from Checkers. Maybe Solly Kramers if you want to up your game. And then if we really want to go crazy, so a child is born today, you put 36,000 Rand a year until you've maxed out the 500,000, which will happen during their teens. You leave that until they are 65 years old. Again, assuming 7% real return, removing inflation, you've got a portfolio of 27 million Rand in today's money, and 4% rule, you're getting R1 million a year. Now, you can get glass bottles. Ching, ching. That's why SARS is not going to increase the 500,000. Your secret there is twofold. Time, no tax. And it is powerful. The tax is massive. Your tax saving. I mean, your CGT in liability in there is 26,700,000. Except SARS says, don't worry about it. Nice SARS. This is staggering. The best thing you can do, so the best thing you can do is open this for a kid. You can legally do it. That's not a problem. Here's the thing. You've opened it for the kid. It's in the kid's name. The kid turns 18. It is their money. Now, I remember being 18. Yeah. You've got 18 years to impress upon that kid not to panic and spend it. But here's what you've also done for the child. That child never needs to save for retirement. They never need to worry about their Reg 28. They are home dry. They are sorted. Now, let's be clear. You've given this child 500,000 Rand in the first 15 years of their life. I mean, it's, you know, like, I don't know, my dad gave me a fishing rod and I thought I was special. You know, different eras, perhaps. That was the 70s. But yeah, I mean, the numbers are absolutely staggering and significant. So your next tax-free is your Reg 28. This is your pension provident retirement annuity. If you work at an official corporate, you probably have one of those. You can put in 27.5% or 350 Rand, 350,000 Rand, whichever is less. And what's important here is that this reduces your tax liability. So if you earned R1 million in the year, you can put in 275,000 Rand, and then your R1 million, you don't get taxed on R1 million, you get taxed on R1 million less the 275,000. So you pay less tax. However, at the end, one day you retire, you can take a third in cash, you buy annuities with the other 2/3, you take the money out, you're taxed, and you make money off those proceeds, and you're taxed again. So this is, in the immediate, this is more tax efficient for you because it reduces today's tax bill, whereas the tax-free account doesn't. But in retirement, it's less tax efficient because you pay tax. You can get a living annuity, you can get a guaranteed annuity. I'm not going to delve into the complexities around those. If you pay excess, let's say you earned R1 million, you can put in 275,000, but you put in 400,000. SARS is only going to credit you the 275,000, but they're not going to penalize you for the extra. You can roll that over, and you can roll that over forever, because one day you won't be earning R1 million, and then suddenly you can start clawing back that tax benefit that you've got. So if you put, say, an extra 100,000 a year and you do it for 10 years, you've got R1 million credit sitting with SARS that you can use at a later stage. Reg 28 products are very different from what they were back in the day. They used to be fairly horror. They're a lot better these days in terms of fees, product availability, transparency, and the like. I chatted with a person in, I think it was Cape Town last year. He was 78. He said, I've got a tax problem. I'm earning too much money. I'm like, I'm here to help. He was like, should he open a Reg 28 because it'll reduce his tax liability? I'm like, sure, why not? He says, I'm 78. I said, sure, why not? Because he was earning income, he was paying tax. Instead, he put some of it into a Reg 28, didn't need it, reduces his tax liability, and he can cash that Reg 28 anytime he likes. After the age of 55, you can take it out whenever you like. We also now have the two-pot system. So 30% of monies added in can be withdrawn. Not historic monies, you had that 30,000 one-off. But if you put in 300,000, you can take 90,000 out. You will be taxed on that 90,000 that you take out. The tax benefit in the Reg 28 occurs now. There's a lot of hate to Reg 28s. I used to be of one of those haters. They are a better product. I like them. The tax benefits are real. The fact that you have to buy annuities is not the end of the world. The limits in terms of 45% offshore doesn't stress me because I can buy NASPAS locally, and that's technically China. I can buy Richmond, that's technically the world. I think they're actually good products these days. Just watch out, as always, for fees. Interest exemption, if you are earning interest because you have money in the bank, or maybe because you have some bonds or RSA retail bonds or something. If you're under 65, your first 23,800 is exempt from tax. If you're over 65, your first 34,500 is exempt from tax. Those numbers haven't changed since 2015 when tax-free investing accounts were introduced. SARS is basically pushing you into that rather than the interest exemption. My view is take that exemption. Make sure that you are earning 23,800. Now, maybe you're earning that from money in your bank account already. Maybe it's your emergency fund. I don't know, whatever the case is. But make sure that you're earning 23,801 Rand interest every year if you're under 65. So when SARS says, did you earn interest? You said, well, 1 Rand, tax away. In fact, you know what? Take the whole Rand. The point is that there are tax benefits out there, and it's our job to grab them. Mostly, the finance minister tomorrow will stand up and take money out of your pocket. Sometimes he puts it back in. Let's take the most of putting it back in. So which is best? All of them. All of them. 10 years ago, I would have had different answers, but in February of 2025, all of them. They're different, they fit different places, they have different processes, but they're all worth looking at. Let's grab a quick look at some products. Tax-free, I like a broad-based. I like to have income heavy, such as REITs, because REITs are income, not dividends, so it's not 20%, it's at your marginal tax rate, so I like to put REITs in there, and then I'm liking some tech at the point. At some point, I probably have to sell my tech, I don't know when. For now, I'm just enjoying the ride. One day you'll see me crying on the street corner, then you know I missed the sell. But here's a couple I like. So this is global. This used to be core shares, it's now 10x. I think there's 16,000, no, maybe it's 9,000 shares. There's a ton of shares in there. You will note that it's tech, right? This is a global ETF. But where's my non-tech in the top 10? This is currently a global tech economy. All of those are tech. What it does is it downweights them. Apple's only 4%. It does downweight them. The total expense ratio is 0.29%. I have a view of one ETF to rule them all. Every month, I bang off a debit order where I use AutoShare Invest with an internet banking, and I buy an ETF and I buy that one. That is just my bog standard ETF. It's nice. It's diverse. There's some quirks in how it defines sort of emerging markets and the like. So it actually has a little more emerging markets than many others would have. So the percentage is about the same. But some providers consider South Korea emerging market. I think they don't. So you get a little bit more of true emerging markets, which is mostly going to be China, some South America, some Asia, and probably no Africa, but that's fine. We live in Africa, we have investments in Africa, we have homes, cars, and lives in Africa, so we've got exposure there, absolutely. So that is one of my faves. That's the one I buy every single month. I've got a load of it in my tax-free as well. This is the Infotech from One Invest. Note that suddenly Apple is 23%. So what this one does is it takes the S&P 500 and it takes tech stocks. Now you will note no Amazon, because Amazon is considered, I think, services or consumer services or something, but it takes tech stocks only. There are about 70 of them, puts it in a single ETF, and when tech is running, this thing is on fire. Love it. Total expense ratio 0.36, ETF 5IT. These can all go in a tax-free account. They can, of course, all go in your discretionary account as well. If you're looking for SA Inc., the best place to find SA Inc., and truthfully, not 100%, there are some actively managed certificates which are focused on SA Inc., but they can't go in your tax-free account. Here I'm looking at your tax-free account. Truthfully, the mid-cap is about the closest we get to SA Inc., and you can have a swing down. There are some exceptions. There's some miners in here, for example, Impala. There's Nepi Rockcastle, which is Eastern Europe. There's Harmony, and Discovery is a little bit global, but it's Bidvest, it's Clicks, it's Remgo, it's PEP, it's Mr. Price, it's Aspen. So it's sort of like your South African economy, very much so. From F&B, total expense ratio 0.59. If you're looking for emerging markets, Signia has their MSCI emerging markets. It is 0.41. You will notice that a lot of this is China. So Taiwan Semiconductor Manufacturing Company, obviously is Taiwan, but it's tech. And the China is Tencent, is Alibaba. We've then got China Construction, the ICICI, the Honghai. I'm not even sure what half of these do. And then, of course, some Samsungs, etc., etc. Mostly Asia. Within Asia, mostly China. And fairly tech focused. Again, it's because tech is just dominating the world at the moment. As I say, one day, I was going to say one day that'll definitely change. One day that'll probably change, but I don't know where we go from tech. Anyway, so those are some of the availabilities. The new one from ETFSA, which I really like, and in fact I bought some for my sister when it was an IPO last year. What's nice about it is it's a foundation balanced ETF is what they call it. Relatively new. ETF SAB is the code, technically actively managed, but that's because there's no index to track. And what you can see is a whole bunch of SA top 40. Then we've got some property, then we've got government bonds, then we've got income, cash, and then we've got some offshore at the same time. Offshore is approximately, if I put those together, about 35%. And what they will do is keep those ratios in place. So it's very much your foundation. It's equities, local and offshore, it's property, and then it's essentially bonds and or cash generating. It's never going to knock the lights out, but it's great for that core part of your portfolio. I prefer the global, which is higher risk because it's all equity. This comes in lower risk because it's got cash and bonds at the same time. JustOneLap.com/fave ETFs. We went and asked some of our favorite people what their favorite ETFs were. You can find that on the website. I will warn you up front, there are some crazy ETFs that they selected. No, not even cannabis. Rochelle came up with, I mean, there were some crazy ETFs there. But trust me, everyone there, perhaps the one in the corner, but there are some immensely smart people there. And they give you why, what, and how. For me, it's interesting just to, like peek into other people's portfolios and see what they're thinking. It's there, you can go have a look-see and get, and to be quite clear, no one's giving you investment advice in that regard. You look behind the curtain, you take your own risks. Reg 28 product, you want low cost? I like passive. What's a low cost Reg 28 product? About 1%. Now, if you work for an institution, you might not have a lot of choice, but if you're putting extra in, you certainly do. And as I say, low cost and passive. And low cost these days, I mean, maybe it's 1.25%, but it's not 3, 4, 5, 10, 20. And when you laugh at the 20, I bought a Reg 28 in the 90s, and I don't know, someone made money, it wasn't me. And if you want interest exemption, RSA retail savings bonds, the rates reset every month. Boring, 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 but nice. And you want to make that interest exemption, this is one way to do it. The inflation-linked ones, your capital goes up by the inflation rate, and then it pays the yield on top, but both the capital increase and the yield are considered income. The trick with this is it's income, it's interest. So if you earn 100K on here, it's added to your income, less your interest exemption. So this is one place where you can get that interest exemption. As a disclaimer, someone has contacted myself and other media to claim there was fraud on their account. Two things. It's RSA retail bonds or National Treasury aren't denying his. What he says is someone went in, changed from an email address that is not theirs, changed the bank details and requested an emergency withdrawal, which they then paid. They are investigating. My view, there's only one way out: pay the person back their money. The second point is put procedures in place. Man, I can't believe the hardest thing in the world should be to change your bank account details at a financial service provider. I know because I've tried to do it once and it still haunts me. And apparently here it was just like, hey ho. They have put new things in place. They haven't finished the investigation. And I have widely broadcast this fact, and no one has come up and said me too. So maybe it was isolated. We don't know. We wait and see. My wife has money in here. So far, so good. So some burning questions. I've answered a bunch of them, but let's go through some of them that I haven't. Can I buy and sell within a tax-free account? Yes, you can transact as often as you want. All that matters is the annual limit and the products that are available. Many of your providers, my tax-free account sits within standard online share trading. If I try and put in excess money, they will tell me to go away. And if I try and buy something that is not allowed, they will tell me to go away. So they are kind of guarding me, ring fencing me in that regard. But once it's in there, knock yourself out, buy whatever you want. Dividends that are received are not part of your limit. Buying and selling is not part of your limit. Can I have a passive low-cost Reg 28 product? You can. They've certainly become more popular. There are a number of providers, and some of the big providers who you would think perhaps don't. Alan Gray has a really good, really low-cost passive Reg 28 that costs about 0.8% a year before advisor fees. But if you manage it yourself, no advisor fees either. Can I have them for my kids? You can. Process is quite simple. The kid doesn't need an ID number. The guardian will have to do the FICA for the child. The kid doesn't need to have a bank account. But when the money is withdrawn, it must go into the bank account of that person's name. So you can't take your kid's money, draw it into your name and go skiing. It's got to go into their account in their name. The other one I often get asked is, you know, I'm 102 years old. Is it worth it? Sure. Because you might only live to be 112 years old, but that's 10 years of tax-free. Now, to me, being too old in terms of investing is neither here nor there. Your risk profile might be different, 100% agree on that. But don't say, oh, I'm old, it's not worth the time. No, there's tax saving to be made. It's always worth the time. Absolutely. Can you change what's inside? You can change as frequently as you want or as infrequently as you want. You'll typically find that brokerage fees within tax-free accounts are cheaper than a traditional account. So you're looking at about 0.25% or so. You can buy and sell up a storm. Careful, make sure that the buying and selling up a storm isn't losing you money. Can I have more than one Reg 28 or tax-free? You can. You can have as many as you want, but the limits are per individual, not per account. So if you've got 10 of whatever, it doesn't mean you can have 10 times. It means you can have 1/10 in each. Or you could have 9 that do nothing and everything goes into the 10th. You can have multiple. Yes, absolutely you can. Will the limits increase? I don't think so. I don't think so. I think our finance minister has bigger problems on his plate right now. The lifetime limit, I don't see increasing. The 36,000 might increase to 40,000 for tax-free per year, per individual, maybe. The Reg 28, I don't think so. I think he's going to leave it at 27.5 and 350, and I don't think that, well, interest exemption hasn't changed in a decade. I don't expect that to change either. I think a lot's going to happen in the budget tomorrow, but I don't think we're going to see any changes to what I've been talking around today. Crypto, no can do. Just that simple. Offshore holdings, directly, no. Indirectly, yes. That global ETF I showed you, it's got offshore shares in it. In fact, it's all offshore. And they take your ZAR, they turn it into pounds, euros, dollars, buy the various different shares, so you get the benefit of both the share price and the currency movement. Rand weakens, you get some upside. So you can get offshore indirectly, but you can't go put a New York listed ETF into here. that you can't do. Can you hold cash in there? You can, which is deeply, deeply boring. But as a, it depends where you are, as I said, in your retirement process and your risk profile. And maybe there comes a point where actually it's a case of, well, let's look at cash. The trick then, I wouldn't hold direct cash because you're not going to earn a lot of interest within it. There are ETFs, for example, the Satrix Tracy, which tracks the cash rate. There are income funds that are ETFs that have been issued by most of the issuers these days, which are in some cases yielding up to 8, 9, even some of them above 10%. So there are ways where you can have near cash and get a decent yield from it. Typically, cash is, one of the things I think that we as individuals make as investors is we have too much cash when we should be taking on more risk. If you're 20 years away from retirement, your cash holding should frankly be an emergency fund and enough to max out your interest exemption. And you say, oh, but Simon, the market's going to crash in the next 20 years. Sure. But you know what it's also going to do in the next 20 years? Recover. Yeah. If you're retiring tomorrow, different conversation. Except that if you're retiring tomorrow, you might have 30 years of life ahead of you, which still means you don't want to be, back in the day, my grandfather retired at 65 and made it to 66, man. So, and when he was 65, you turned everything into cash because your life expectancy was, months. No longer the case. When do I spend the tax-free money? Last money that you spend. Because the longer you leave it, the more it grows and the more tax you save. So as I said, you spend your Reg 28, you spend your discretionary, you spend the kids' inheritance, then you come for your tax-free account. Important, tax year, 1 March, 28 or 29 February. When you send the money, does not matter. When the money arrives in the account that you are sending it to, that is what matters. Do not leave it lastminute.com. Do not send it at 4 o'clock next Friday because it will fall into the next tax year. You know what happens when you send money? Goes on a little holiday, off to eThekwini, checks out the beach, has a bunny chow, maybe a beer. 2 days later arrives in the bank account. Don't wait for the last minute. Friday next week, end of tax year. If you want to be moving monies around, man, be doing it this Friday. Because every time on about the 4th of March, I get someone contacting me. And it's always like, there is nothing anyone can do. It arrived in the new tax year. Is it somebody's fault? I don't know. What do you want to do? Hang in court to them? We don't do that stuff anymore. They're set for next year. Don't tell them that though, because they don't see the logic in that at all. That's me done. Quick point here. Online share trading, local offering, important you can have a tax-free account sitting within there. Auto Share Invest, which sits within the internet banking, Standard Bank. You can also have a tax-free account that sits within there. Then, of course, Shift, no tax-free account in Shift for its offshore, ditto with Web Trader. I have run my time, but if there's a quick question or two, otherwise we will see you folks next month.
Within your tax-free account, is the capital gains tax applicable?
Nothing. Yeah. So typically you would buy an ETF at 30 Rand, sell it at 40, you've made 10 Rand. Government is like, you've got a 40,000 exclusion, and thereafter 40% pay us the money. Tax-free account, there is the only tax you pay is there'll be VAT on brokerage, which kind of irks me, but you know what, it's fine. And then when you die, it goes into your estate, and it is then taxed in your estate, but you've got bigger problems, right? You're dead. Like, the tax on the estate is not your problem.
So just another question, just on the 10x global trading ETF, if you invest in that, there's I think the trading expense ratio, you mentioned a particular rate. Is there a monthly subscription to 10x? Or can you 10x via?
Great question. No, so the question is that total expense ratio, which is the fee. How do you pay it? It comes out of the dividends. So you don't have any relationship with 10x. Well, you do. You hold one of their products. What they do is these ETFs and all the AMCs, they receive the dividends from these companies. Dividends are the profits that they make. They are returned to shareholders, you and I, as the holders of these shares. but we hold them in a structure, an AMC, an ETF, an actively managed ETF, whatever the case may be. That money flows in, they hold it for you, and once a quarter they will pay the dividend out. They earn interest during that period, they also pay you the interest out. From that, they will deduct the fee. So you pay the fee, effectively gets deducted from that dividend payment that comes through.
It's a retail bond. When it matures, you take it out of it,
I reinvest. At this point, I'm reinvesting. I mean, so what my wife and I did, April 2020, 11.5%. World is ending. I'm like, I like me some of that. So stuck it in at 11.5. Couple of years, it went down. A couple of years later, it was back at 11.5. We reset for 5 years. Went down a little while later, back at 11.5. I think just before the election last year, reset for another 5 years. So April 29, we're going to have the challenge. We just want to leave it there, partly because it's earning me a nice rate. It solves the tax interest exemption, but also if you need it in an emergency, they'll give it to you. Now the trick is any accrued but unpaid interest you forfeit. But if you need the money in emergency, you know, so not a my geezer's broken, but I don't know, I lost my arm. And they're like, cool, money for a new arm. Great question. Not sure. Suspect dividend. Suspect it's dividend because they're managing it internally. And what they're doing is, so this is the private credit, unlisted credit out of the US. They're not directly lending money. They're buying funds that manage it or various different products. They're probably receiving it, but paying it to you as dividend. It's a worthwhile question. If you drop me a mail, I can get you the answer. Yeah. Ma'am.
Assuming I have no financial strategy, right? And I have 1,000 rand extra every month. Do I pay? Let's say I have a loan that is at 9%. Do I put extra towards the loan or rather? Great question.
So you have a loan, but it's at 9%. 9% doesn't stress me. If your loan was 21%, I'm like, pay the loan, because you're going to earn 21% on the loan. At 9%, it doesn't particularly stress me. That said, and this is a personal thing, debt generally bothers me. So there's an argument to say, well, maybe get rid of the debt or maybe put 500 into the debt and 500 into an investment. The question to me is always, when people say, should I pay debt first or should I invest first, is what's the cost of that debt? Because the question is, what can you earn in the market? Can you earn more than 9? Yes. Can you earn more than 20? Probably not. So in that case, 9% doesn't stress me. But to the point, if it's stressing you, well, then get rid of the loan because you're currently paying something. Let's say you're already paying 500 there. You pay off the loan. Now you got your 1,000 and your 500. You got 1,500 to do every month.
But if I'm removing emotions and anything, would it be better to just put it towards the tax-free?
Correct. Put it towards the tax-free. Yeah. Emotions aside. Ladies and gents, I'll park there because my time is done. Apologies for that. We're back 31 March. Thank you all for coming through. Good news, you don't need to validate your parking because the system is offline. There'll be a man downstairs. He'll wave his wand. We'll all go out. Thank you very much for coming through. I appreciate it. It was raining. It was wet. The roads were dangerous, but we're all here safe and sound. Thank you very much for your time this evening.